In 2024, central banks around the world bought over 1,000 tons of gold, the second highest on record. In 2023, Russia and China began settling trades in their own currencies instead of dollars. In 2022, U.S. national debt crossed $36 trillion, topping 120% of GDP, while interest payments alone hit levels not seen since World War II. In 2021, the Federal Reserve's balance sheet expanded to $9 trillion. In 2020, Americans collectively saved over $2 trillion, yet household wealth inequality exploded. The top 1% now controls nearly a third of all wealth, while the bottom 50% barely holds 2%. In 2019, the IMF warned that global reliance on a single reserve currency could create systemic instability. So here's my question. What happens if the US dollar loses its role as the world's reserve currency, the backbone of your retirement plan, your savings, your sense of financial security? Hey, I'm Brian. I spend way too much time thinking about money, markets, and the hidden rules that actually govern your financial life. I've spent years analyzing global monetary trends, researching central bank behavior, and building my own portfolio through cycles like this. I'm not here to sell you panic or tell you to buy my course. I'm here to cut through the noise. Here's the contrarian truth. We're not heading into another recession. We're heading into a structural shift that could redefine the value of the US dollar itself. If this topic matters to you at all, hit subscribe, because understanding this now is how you actually protect yourself, not just react later. Think of the global dollar system like a skyscraper. Not just any skyscraper. A gleaming tower that stretches above the clouds, filled with offices, apartments, and shops. Each floor, each pillar, each beam represents a layer of trust. Trust in the U.S. economy, trust in the dollar, trust that debts will be repaid and contracts honored. For decades, this skyscraper has looked solid, unshakable. People moved in, investors poured money into the elevators, and the world assumed the structure would never fail. In a normal world, the floors hold up, the pillars support each other, and life inside the tower feels safe. That's what we've believed for 80 years. The dollar is stable, the system is predictable, and if you save, invest, and retire responsibly, everything works out. But here's the problem with invisible pillars. You can't see their internal cracks. You don't know when stress on one level will ripple to another. You don't see that some pillars are already weakening. Over-leveraged debt, offshored manufacturing, eroding trust. And when a critical pillar fails, the tower doesn't just lean a little. Floors can shift, elevators stop, and suddenly your apartment isn't worth what you thought it was. That's the reality we're approaching. The question isn't if something happens, it's when, and more importantly, how deep the damage goes. The skyscraper has been shaken before, but never with this combination of debt, demographic stress, global competition, and erosion of trust. And unlike past shocks, we can't simply patch a floor or replace a beam. The entire structure is undergoing a fundamental redesign, whether we like it or not. This metaphor isn't just for effect. It's how I think about what's coming. A slow, grinding structural shift that won't show up on your brokerage statement immediately, but will quietly erode your future purchasing power and retirement security. Let's put some numbers on that skyscraper to understand exactly how fragile it's become. The first pillar is debt. The U.S. government now owes $36 trillion, 120% of GDP. To put that in perspective, imagine if your household carried the same ratio. A family earning $100,000 a year would owe $120,000. That's manageable once, maybe twice. But $36 trillion isn't a one-time problem. It's interest piling on interest. And unlike the post-World War II era, this debt isn't being used to rebuild an economy. It's being used to maintain a lifestyle and pay interest on past borrowing. That's not a debt problem. That's a structural problem. Next, consider wealth inequality, another crucial pillar. The top 1% owns 32% of total U.S. wealth, while the bottom 50% owns barely 2%. To put that in household terms, imagine if one person in your city owned nearly a third of every house, car, and bank account, and half the population could barely afford rent. You might be thinking, we've seen inequality before, it didn't topple anything. True, but here's what's different. Inequality today interacts with global monetary fragility. Concentrated wealth can manipulate markets, while the majority has no buffer when the tower wobbles. Now, let's look at the global trust pillar. In 2024, central banks bought 1,037 tons of gold, the second highest purchase in history. That's not a casual hedge. It's a signal that governments are preparing for a system where the dollar may no longer be the unquestioned anchor. Meanwhile, countries like Russia, China, Brazil, and India are increasingly settling trades in their own currencies, bypassing the US dollar entirely. This isn't theory, it's happening right now. Even the Fed's balance sheet shows the strain. At $9 trillion, it's swollen beyond recognition, absorbing trillions in assets just to keep short-term rates low. That's not a market correction. That's a pillar under tremendous stress. Look, these numbers aren't just scary, they're math. And math doesn't lie. The skyscraper metaphor works because every one of these figures represents a load-bearing pillar, quietly stressing the system while the elevators keep running and tenants still pay their rent. But when those pillars start to fail together, the floor beneath your financial plan may shift faster than you realize. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Here's the thing. Numbers alone don't topple skyscrapers. It's human behavior that determines how quickly cracks turn into collapses. And this is where psychology plays a decisive role. Ray Dalio, who has studied centuries of financial cycles, emphasizes the importance of trust in a reserve currency. He notes that when trust erodes, even slowly, people start hoarding, hedging, and looking for alternatives. That's exactly what we're seeing today. Governments are buying gold, diversifying reserves, and creating new payment systems. Investors are quietly reducing dollar exposure. And when enough people act on that mistrust, it becomes a self-reinforcing cycle, a slow-moving bank run at the global level. Behavioral economics shows us the same pattern at the individual level. When uncertainty rises, humans overreact to fear or ignore long-term signals, clinging to past assumptions. They think, the dollar has always worked. Why change now? Fair point. But here's the kicker. Historical patterns only hold when structural conditions are similar. Today, they are not. We have an aging population, offshored manufacturing, and a debt structure that wasn't there in previous crises. Inequality amplifies the effect. The top 1% can protect themselves, buy gold, invest offshore, or hedge with alternatives. Meanwhile, the bottom 50% has almost no buffer, relying entirely on stable wages, savings, and the dollar's purchasing power. When the tower wobbles, the consequences aren't shared evenly. Those at the top can ride it out. Those at the bottom get crushed. Look at real-world signals. Russia and China settling trade in their own currencies isn't just geopolitics. It's psychology in action. Trust in the dollar is eroding. And when nations act first, others follow. It's herd behavior amplified by incentives, creating a cascade effect. And here's another subtle point. Most Americans have built their retirement plans assuming the dollar is invincible. 401ks, index funds, bond ladders, all built on the assumption that the skyscraper's pillars will hold. But when the psychology of fear, mistrust, and inequality intersects with weak pillars, even the best-laid plans start to unravel. That's not speculation. That's math plus human behavior. The numbers we saw earlier show the load, but psychology determines when the floors start to shift and how fast. Now, you might be thinking, but haven't people predicted the fall of the dollar before? Didn't that never happen? Fair point. The difference this time is the combination of structural, psychological, and geopolitical forces converging simultaneously. Look at 4 concrete examples. Currency alternatives. China and Russia aren't just diversifying. They're building independent payment systems to bypass the SWIFT network. That's a direct challenge to dollar dominance. Gold accumulation. Central banks bought over 1,000 tons of gold in 2024, signaling preparation for a post-dollar world. Offshore manufacturing and debt mismatch. The U.S. imports much of its goods while holding unsustainable debt. That dependency makes it vulnerable to external shocks. Dollar-denominated bonds under threat. Countries that hold massive U.S. debt now question whether they'll be repaid in dollars that hold value. That's not theory. That's happening right now. Here's the kicker. Each action feeds the next. When nations reduce dollar exposure, confidence drops further. Other countries hedge in response. Investors follow. It becomes a self-fulfilling prophecy, exactly like a bank run. And unlike previous crises, the response time is compressed. Information travels instantly. Incentives are aligned to accelerate exits. The skyscraper isn't wobbling slowly over decades. It's shifting floor by floor in real time. This isn't a hypothetical exercise in doom forecasting. This is happening now. The global financial system is entering a structural transition, one that could quietly erode purchasing power, savings, and retirement plans, even without a dramatic market crash. Look, slow grind crises are the most dangerous because they don't announce themselves with sirens. They creep in. You don't notice until your floor has shifted, your elevator stalls, and your financial plan no longer works the way it was supposed to. Meet David. He's 42, has a $350,000 401k, and believes he's on track to retire at 65 with roughly $1.8 million. He's done everything right, maxed contributions, diversified in index funds, and stayed invested through previous recessions. According to conventional wisdom, David should feel secure. Here's the problem. His plan assumes the dollar remains the stable, trusted pillar it has been for decades. But if inflation runs at 5% instead of the expected 2.5%, that $1.8 million suddenly buys what $800,000 would have bought in today's dollars. His retirement plan hasn't changed. His assumption about the currency has. Let's break the assumptions down. Stable purchasing power, gone. Prices for groceries, healthcare, and energy rise faster than expected. Safe bond returns. Bonds are underperforming, their yields no longer covering inflation. Predictable global system. Countries are diversifying out of dollars, eroding confidence and increasing volatility. David's statement still reads, "I'm on track to retire comfortably." But the game has changed underneath him. His skyscraper of financial security looks intact on paper, yet the floors are quietly shifting. This is exactly what happens when structural monetary change intersects with human expectations. Even those who follow every conventional rule can end up blindsided. So, what might the U.S. do about this? There are a few institutional options, but each comes with huge political and practical hurdles. Option 1. Cut spending or raise taxes to shore up debt. Politically, nearly impossible. Congress has shown it can't agree on either, and the public would resist. Option 2. Introduce a new type of currency, gold-backed bonds, commodity-backed dollars, or even a Bitcoin-style reserve. Technically feasible, but highly disruptive to existing contracts, bond markets, and pensions. Option 3. Lean on global alliances to maintain dollar dominance. That requires trust other nations may no longer have. And here's a mental image for you. Imagine policymakers in a room sweating over which pillar to reinforce, knowing that fixing one weakens another. It's like patching a crack in the skyscraper while the elevators are full of tenants who don't know the floor is shifting. The bottom line, even institutional responses are slow, messy, and politically fraught. The skyscraper might be reinforced, or it might tilt further before anyone notices. Here's what I'm personally doing about this, and what you might consider as well. Action 1. Diversification outside the dollar. I'm holding a mix of gold, real assets, and a small allocation to Bitcoin. It's not about speculation. It's about hedging against the structural shift in global trust. Action 2. Avoid long-duration bonds. Bonds assume the dollar will hold value over decades. With potential currency erosion, locking in long-term rates is a slow way to lose purchasing power. I focus on shorter-term instruments and floating-rate alternatives. Action 3. Invest in skills and non-monetary value. A dollar may weaken, but knowledge, expertise, and businesses that operate beyond a single currency retain value. I prioritize skills that compound regardless of the financial system's state. Maybe I'm wrong. Maybe the dollar retains its dominance and inflation stays tame. But the data, debt, global diversification, gold accumulation, suggests we can't rely on history repeating itself. Let's be clear. This isn't about a sudden crash or dramatic headline. Monetary transitions don't explode overnight. They grind slowly. Grocery bills creep up, bond funds underperform, and retirement projections quietly fall short. That slow grind is what hits hardest. Ray Dalio's framework warns us that during a currency transition, people who did everything right, saved diligently, invested in the market, bought index funds, often feel the biggest shock. They trusted the skyscraper was sound, only to discover the pillars had shifted while they weren't looking. Here's the thing. The global dollar system is like a skyscraper built on invisible pillars of trust, debt, and confidence. Floors don't collapse suddenly. They shift gradually, subtly changing the value of everything inside. Who gets hurt most? Ordinary people planning their retirement, following the rules, and assuming stability. Not the speculators, not the top 1%, not the insiders. They're positioned to adapt. Intellectual honesty demands I say this. The system isn't failing because of panic or mismanagement alone. It's evolving. And if we watch closely, diversify, and prepare, we don't just survive. We understand the new rules of the tower. Peace.